I'll take this opportunity now to introduce the third paper in the session, which is by Tim Congdon and Juan Castañeda. And the title of the paper is on the 2020-21 surge in the amount of money and the return of inflation and boom and bust cycles. So Tim and Juan really need no introduction, but let me remind those who perhaps might be joining from elsewhere that haven't come across Tim's career and Juan's career. So Tim began his career at first in the Times and then became an economist in the City of London in the 1970s. He advised the UK Conservative government in the 1980s and into the 1990s, serving as a member of the Treasury panel from 1992 to 1997. He was also a founding member of the research consultancy Lombard Street Research, which he left in 2005 to give more time to writing books. And he produced 4 books out of that period of research. He then set up the Institute in 2009, and until 2016, he was the director, but he handed that over to Juan and is now the chairman of the Institute. And Juan has been at the University of Buckingham since 2012, prior to which he was an academic in Spain for 14 years. He's worked with various parliaments, the European Parliament and the UK Parliament, producing reports on the euro and various other monetary issues. And he's been an honorary senior visiting fellow at the Cass Business School, now known as Bayes Business School, and was a visiting researcher at the Cato Institute. And since September 2018, he's been a member of the Institute of Economic Affairs Shadow Monetary Policy Committee. So Tim or Juan, I don't know which of you is going to present, but you've got about 25 minutes, and then we'll turn to discussion.
Okay, hello everyone, and we're running a little bit low on time, so I think what I'll do is we may run up 25 minutes, I'm not sure, but we'll try and, because I think it's important to have some discussion about this rather difficult period that we're in at the moment. Okay, I also just wanted to say one of the things about the conference. One is, Paul, my apologies, I do apologize not introducing you this morning, and I just didn't know where you were. but so that's the challenge of this hybrid conference. Also, can I just say that maybe the hybrid conference is working extremely well. I just want to thank our IT director, Ben Johannes, as well as everyone else has been thanked already. Okay, now I assume that what I do for the slides is just press this thing here. So I think what I want to do first of all is to get over to everyone just how bad the mainstream forecasts were in the spring of last year. I've got then quite a lot of discussion in the paper that we plan to set out about what's wrong with mainstream thinking, which in many ways is Keynesian thinking. And then Juan will take over with a projection of US nominal GDP and implicitly an inflation forecast for the next 2 or 3 years. Now, in fact, it's really what Juan says that's the exciting bit. So I will move relatively quickly through what I have to say. Now, ladies and gentlemen, this is a chap called Olivier Blanchard. He's extremely distinguished. He was chief economist at the IMF for 7 or 8 years, I think up to about 2013, 2014. And in May 2020, he wrote a column for something called the Vox CEPR policy portal. Is there deflation or inflation in our future? Now, this is about what, well, the announcement of the medical emergency in the USA was, I think, the middle of March, kind of 13th, 14th, 15th of March last year. There was then a dramatic developments in US monetary policy, which meant that in the following, so 4 months effectively, it's March, April, May, June of last year, US broad money rose by about 19%. just one, that's not an annual figure, that's the increase in a 4-month period. So this statement was made while that was going on and towards its end. And it says that this column argues that it's hard to see strong demand leading to inflation. And the challenge for monetary and fiscal policy is thus likely to be to sustain demand and avoid deflation rather than the reverse. As I say there, this was after the month of April 2020, in which US broad money rose by 7% in 1 month. And then, roughly the same time, we had some remarks addressed to the Economic Club in New York, 21st of May last year. Again, on the same title, Is There Deflation or Inflation in Our Future? And this is Richard Clarida, who's vice chair of the Federal Reserve. In effect, the chief economist of the Federal Reserve. There are obviously many other economists there, but the chief economist effectively. And he said the COVID-19 contagion shock will be disinflationary, not just over the next few months, but over the next few years. Notice that. And then there's a statement at the end of the meeting of the Federal Open Market Committee in June last year. The Federal Open Market Committee is the most important policy making committee in the world's most important central bank. And this is what it said. I framed it. It picks up this phrase, clearly comes from Clarida. And the forward-looking simulations from the Fed's research staff suggested that the committee would have to maintain highly accommodative financial conditions for many years. Okay, for many years to quicken significantly, meaningfully, the recovery from the current severe downturn. And just notice that phrase, for many years. We are now 18 months or so later. That's all. And US inflation has reached the 30-year peak. Now, look, I have to do this, and it's actually quite important understanding we must not, the country, all the countries have made this mistake, big countries in the last 18 months to years. It mustn't happen again. It probably will happen again, but if we do our best to stop it. This is what I said, with support from Juan, in an email sent out. Some of you will receive the email on the 6th of April last year. Knowing what was happening to the quantity of money, and that was the essential bit of evidence. That was all you needed. You just needed to know week by week what was happening to deposits in the US banking system. That's all you needed to know. At some point, probably mid-late 21, the coronavirus crisis will be over. Well, it isn't, but it's much milder. What will happen if the excess over normal money balance is created by public policy in 2020 and possibly early 2021? I mean, there's another point there, but the answer is that as in the aftermath of wars, because in many ways what was going on was like during and after wars, an inflationary boom in the world's leading economy has to be the central forecast. It seems to me that a major increase in inflation due to this boom is inevitable. I didn't know whether inflation would go to 5% or 10%, because actually quite a bit did depend on money growth after June 2020. I won't go into that now, but we have got 5% inflation, and as Juan will show, there is quite a high risk of double-digit inflation in the US in the next couple of 3 years. Now, there's obviously the major question here is, what on earth were these people, very distinguished people, top of the profession things, this is Blanchard and Clarida. How were they so wrong? Now, I'm just going to be a bit self-indulgent. I've been here before. In 1975, I went to the UK Treasury to meet the people in charge of UK forecasting to try and understand what role the money supply explosion of 1972 and 73 had played in the Treasury's macroeconomic forecasts for the Barber boom of 72 and 73. It was, to me, a shocking meeting. Essentially, the behavior of money had played no role in the Treasury forecasting in the early 70s They knew nothing. There was no link between the behavior of money and the economy in the way the Treasury thought about the economy at that time. They've also been in a situation in the late 1980s, and again, we had an upturn in money growth in the UK. From really early 86, I got concerned about the inflation consequences. At the beginning of the first panel meeting of the Treasury panel back in early 93, I complained, why aren't you people looking at the quantity of money, trying to understand what's happened in the last 5, 6, 7 years, disastrous years? They weren't interested. These economists weren't looking at money at all. It's not integrated in their analyses. Well, the guts of the problem, and I'm not going to spell out because we're running a bit low on time, is that, to me at any rate, this is what the guts of it, is that it does all go back to Keynes, and it does go back to general theory. And the general theory does actually contain the quantity theory of money. It does contain it. And Keynes himself knew the quantity theory perfectly well. I mean, there's some rhetoric against it, but he understood it more or less. And he would never have dreamt of looking at doing a macroeconomic conjecture or forward appraisal without looking at money. He wouldn't have dreamt of doing that. He was, but he also introduced in the general theory another model of the determination of national income, which has then become dominant in the profession. And this model simply says that national income is a multiple of autonomous spending, mainly investment, and investment depends upon the rate of interest. This is the IS function in the ISLM model. And over time, the profession, for various reasons, has found that it wants to suppress the monetary element in the general theory, and then even more important, in Samuelson's 1948 textbook, which really set the whole format, the template for macroeconomics textbooks until today, really. And we actually had a paper by a chap called David Romer in 2000, where he proposed Keynesian macroeconomics without the LM curve. Now, some people here may not know the ISLM model. The LM curve is the bit that brings money into the general theory story. It's all in Hicks's 1937 review article and so on. And what's happened in modern macro, some of it is this expectation stuff. And thank you, Kent, for your presentation. By the way, I wasn't convinced, but that still was great, Kent, that was a good start. Some of it is expectation stuff. Then you get the stuff about what really matters to the economy is the effect of changes in money on bond yields and the rate of interest, and then the effect of the rate of interest on investment, and then the multiplier story. And this has then been accompanied in new cases in particular by a focus in particular on labor markets as where you go to get insight into inflation prospects. So what these people, Blanchard and Clarida, were doing in these catastrophic forecasts, catastrophic misjudgments, was looking at the labor market and invoking inflation expectations, saying they're fine, so therefore we don't have to worry about the inflation prospect. This after 4 months in which the US quantity of money had risen by getting on for 20%. Now, I'm going to shut up now. I haven't, in fact, really, because I'm short of time, I haven't really gone through my slides. Do I need to? I do need to go through my slides to set it up for you, Juan. So let's just quickly go through these. I'm sorry that it's a bit of a rush, but I'm just going to go through these very quickly because I want to set it up for Juan. Look, the guts of the quantity theory monetary story is that equilibrium national income is equal to the quantity of money multiplied by equilibrium velocity. Equilibrium velocity depends upon the properties of the money demand function. I know there's lots of trouble about which aggregate's relevant. I'm sorry, I've sorted that out in my career. It's broad money, always. And I'm sorry if I was angry, but I'm very angry. People haven't understood what I've been saying. And what Juan will do is bring you the message for US nominal GDP in the next 2 or 3 years using that framework, basically. That's all. And the standard models don't have this in there at all. They are that useless, all right? Basically, as Mervyn King said last week, they kind of get by when there are no shocks. When there are monetary shocks, they're just useless, totally useless. Okay, I'm just going to run through this. I'm sorry about this, but we're a bit low on time. So this is really what Juan, and can also just thank here Jose Luis Cendejas, who has got far more econometrics than I've got, and enables us to sort out the stationarity of the change in velocity. So that they're coming along in a second. And then let's run through all this. I'm sorry, I haven't got any detail. Okay, Juan. Okay.
Well, thank you very much, Tim, and thank you, Paul, for your very kind introduction. It's a pleasure to be here with everyone here in the room, and with such an excellent panel of experts, with Professor Ken Matthews, John Greenwood, and indeed my colleagues, Jose Luis Cendejas from the University Francisco de Vitoria in Madrid, and indeed the chairman of the institute in Congdon, my colleague. So I will continue with the second part of the presentation, which is very much about what Tim said already, which is a projection of what inflation will very likely be, in our opinion, in the next couple of years in the US. We are going to use the framework that Tim has already put to you, which is the use of the quantity theory of money in order to extrapolate what's likely going to happen with inflation based on two major ingredients, if you like. One is money velocity, how much the demand for money is going to change and whether it's going to return. That's our hypothesis to the pre-crisis levels in the next couple of years, and how much money is going to be created in the next couple of years by the US Federal Reserve and also the banking sector in the US. So in order to run these projections, we need two pieces of information. One is an estimate of the equilibrium of income velocity in the US from now until mid-2023. And the other one is what's the expected path of money growth, in particular broad money growth in the US for the next 2 years. Here you have a chart with the V in the quantity equation for money velocity in the US for a very large period of time, 100 years, 1918 to 2018. And as you can tell, it's fairly stable, but it follows a mild declining pattern since, again, the end of the First World War until 2019, until the start of the COVID-19 crisis. Here you have money velocity in volumes, but changes in money velocity. So the rate of change in money velocity, the annual rate of change in income velocity in the US since 1999 to 2019, right before the start of the pandemic. As you can tell, there are fluctuations in this series, particularly in the first few decades up to the 40s. It did fluctuate quite a lot at that time, and then it became much more stable. So one of the premises of an analysis that allows us to run this monetarist exercise is that the changes in money velocity are there in the data, but eventually they revert to a mean. That's crucial to the understanding of the exercise that we're doing today. So we need to make a distinction between two series, money velocity in volumes here, as you can tell. It does decline, and I will tell you in a minute how much it does a year, and also changes in that series, annual rates of growth or decline in the series. Well, what has been the behavior of money velocity in the US in the last 100 years? Well, according to the data that we have analyzed, the mean value of money velocity in the US has declined by -0.8% per year in the 93 years before the pandemic. And as I will show you in the next slide, and this is an exercise that we have conducted with our colleague Jose Luis Cendejas, changes in money velocity are indeed stationary, which means they revert to the mean of the series. And again, that's crucial, because if we want to understand what's going to happen in the next few years, we need to make an assumption about how much or what will be the behavior of money velocity in regard after the pandemic. Will it stay that low as it was in the last few months, quarters, or will it come back towards or return completely to the pre-crisis level? According to the data that we have analyzed, let me anticipate that in our view, it will return to the pre-crisis level. If we observe trends in money velocity in the US in the 9 years before the pandemic, in the 2010s, it's very clear that it had a very stable behavior that I will show you in a minute. Here, as you can tell, in the last 10 years, 9 years before the pandemic, money velocity remained quite stagnant, quite stable. So it didn't really reduce as much as it did in the previous 90 years. In our opinion, but this is of course contentious and indeed controversial, this is because of the new legislation affecting banks in the States, much more stringent for the banking sector, that reduced the competitiveness of the banking sector in the US. But again, this is maybe something we can explore in a different talk. However, what we can see, or we have already observed in the data, is that the 2010s was a period of fairly stable macroeconomic conditions in the US, at least, characterized by very similar rates of growth in broad money, M3 in the States, and nominal GDP, and with a fairly steady rate of growth of inflation, output, and fairly low inflation. So in that sense, we can claim that it was a period of something close to what we can call monetary equilibrium. Here you have the statistical output of the test that we conducted, in particular, the stationarity test, a unit root test, if you like, the augmented Dickey-Fuller test, that we applied to the series in changes, in annual changes. This is very important. So if we don't include 2020, or either if we include 2020 or not, in both cases, we can accept the hypothesis that the series in rates of changes is stationary. So it does revert to the mean. In both cases, again, either if we include 2020 or if we don't. If we include 2020, the mean rate of growth of money velocity is around minus 1.1%. If we don't do, as I said before, is 0.8%, a secular decline of 0.8% per year. But again, in both cases, the assumption that we can make now much more consistently, because it's supported by the statistical analysis we have conducted, is that changes in money growth, as high as they can be, as low as it got in 2020, eventually it will revert to the pre-crisis level. Well, what we do, as I said before, we need to, in order to run our projections, we need to know what the rate of equilibrium of money velocity changes will be, or has been in the last few years. So what we have done is to regress the income velocity of raw money on time. And we have calculated, well, we did it in the 9 years before 2019 with quarterly data. And we came up with this regression with 1.098 as the value of the intercept, and minus 0.0046, that's the value for the time term. Well, the only one that is significant, statistically significant, is the intercept. And that's why we take this value as the equilibrium, plausible equilibrium value for income velocity of raw money in the US. Well, here you have the behavior of the series in the 9 years before the start of the pandemic. So on the top chart, you have changes in income velocity of raw money in the US, M3. And obviously, if we change the axis, of course, that's the bottom chart, you can tell that it has been fairly stable. Well, now the projections. I'm going to skip 2024 just because of the time constraints. I'm more than happy to also comment on those. I'm going to concentrate on the projections that we have made on inflation from now until mid-2023. Well, we're going to assume that by that time, by mid-2023, monetary equilibrium, in the States will be restored, which means that money velocity will go back to its pre-crisis levels.
No, we actually bias it in favor of the other side by saying it's 10% lower.
That's exactly what I was going to say, Tim. Okay. It's right there on the slide. So, but in order to concede a point to the other side of the argument, we're going to assume that it doesn't return fully to this equilibrium level, but it's going to remain 10% below that equilibrium level. Just to take into consideration those arguments that state that money velocity, well, is going to remain fairly low, even few years after the pandemic. How about money growth in the next couple of years? Well, we're going to assume that for the rest of 2021, money is going to grow at the same rate that it has been growing in 2021, which is around 9%. And from the start of 2022 up to mid-2023, it's going to be cut down quite a lot, down to 4.1%. And that was exactly the average of monetary growth in the States up to mid-2019. So those are the assumptions that we made. First, at some point, the Federal Reserve will be much more conservative. It will take down money growth to much more moderate values, around 4%. And second, money velocity is not going to return fully to its pre-crisis level, but it's going to stay 10% below that level. Those are the inputs that we take into consideration when calculating our inflation projections. If we take into account this information, then we reach out to the following output. The implied increase in the nominal GDP in the US between the second quarter of 2021 and the second quarter in 2023 is about 27%, 27.5%. That's quite extraordinary, but that's how extraordinary the rate of growth of money has been in the last, it's going to be, in our opinion, in the last few quarters. So that implies that the rate of growth of nominal GDP in the States in 2022 and 23 will be 13% per year. If we assume that the real rate of growth of the GDP cannot be, I would say, more than 2% per year, the rest is going to be inflation. That's why our central projection and the most likely scenario, in our opinion, from now until mid-2023 is that inflation, CPI inflation, of course, will be around a range of 5 to 10% in the next nearly 2 years, 18 months. But if, it's not completely impossible that it will reach 10% or even a little bit more than 10% in the next couple of years. But the central projection, inflation will remain around 5 to 10%. This is, I hope, Paul, that I haven't taken too much of the time of the session, and I'm more than happy to take questions from the audience. Thank you.